Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, all. Ira Epstein of Linn Associates with your financial market update for this Tuesday, and this is the 5th of December, 2017, about 4:40 p.m. Central Standard Time. You know, today I was on Sky Business in Australia this afternoon. I was asked a question and it got me to thinking. Let's assume that you're a asset manager and you have got your clients up, like in the stock market, 30% or whatever for the year, 25%, because some of the indices are there. It would not surprise me if we get a round of profit taking for no other reason than to lock in gains, do some rotation in stock indices. We see that at year end often, and I'm wondering, because of the stellar performance this year, if we're not going to enter that a little earlier than normal. And here's why I say that. We have a tax bill in front of us. Why risk anything? You don't have to. Then you've got situations where you're looking at, gee, if that doesn't do it, why would I want to blow a good year for my customer? They won't do that either. So having been in this industry for 4 decades, having owned at one point my own stock firm, having been a stockbroker, that mentality does set in. Doesn't always for every broker, but it does, and it's rotation time. And I think we saw that with the tech stocks, which got a little bit of a bid today, and now the other sectors coming down, the financials and the like, as the market gets itself just, I think, into a position where it's going to see the employment data on Friday. It's going to deal with an FOMC meeting coming up. All the reasons are there. When we come to the December S&P 500 index, you can see how beautifully this market has gone up. I mean, this is 2017 right here. This is a weekly chart. If you're in the stock market, you've really done well. If you're looking at a daily area chart of closes, we had one recent correction mid-November that saw the market soar about 100 points, 90, 80 points right in that. So I can understand a little bit of a sell-off here. It doesn't mean the trend is changing. There's some rotation, I think, going on. You can see this pattern, down and up move like that. Often this is accompanied by what's called a top action. You'd have to take out this high to convince me that we're not in for a bit of a correction right here. And I saw this years ago with a gentleman, I think it was called Walt Bressard from Cycles Trading. And if I'm correct, he called this, and I could be wrong because I'm going back many decades, a Lindahl wiggle for whatever reason. And he often said it just shouldn't take out that high if it backs off. You know, I used to have my own show on national TV on stocks and options and futures. So I had all what I think were the top analysts in the country on at those points for many years. And, you know, you learn the patterns from them because you get a chance to ask them questions after the show. As I'm looking at how this market's going, got higher lows, higher highs here. The market is pulling back. As long as 2605 is not taken out, you don't violate anything there. I would expect the 18-day average is going to rush up and be very close to that number. So I'll stick my neck out and say if we correct, I wouldn't be surprised if the battleground again turns out to be just the way it did back here, the 18-day average of closes. If I'm right that profit taking setting in right now, you'll get a wave of it, and then at the end of the year, you might get that last move at the last week of the year into that Santa Claus time. Who knows? In the Bollinger Bands, you got up to them and you have failed again. So we're establishing something of a widened out trading range, and I think you see that in the Bollinger Bands right here. Volatility hasn't gone away, so you can still sink a bit. And the thing that scares me and what got me thinking today was I had written in my morning consultancy report, which many of you get. If you get my market research, I call it my consultancy report. I had written down that I thought 2642 was a key number today in the S&P, all because when the market in the early morning was up, I saw that it lost its embedded reading if it stayed under that number. And if you go back and you look at 5-minute charts during the day, you'll see that that was the case. So if you lose the embedded reading, often, not always, price and the 18-day average try to come together. In the NASDAQ, You have been fighting in the Bollinger Bands. You got to the top band, to the lower band. This market is now in an area where when it reopens, I would not be surprised if it immediately goes with a reading in the slow stochastic under 30, which is oversold. But this was one of the leaders to the downside, so it could be the one that starts reacting the best. And in the Dow, you managed to buy a hair, not lose the embedded reading. Now, had this market stayed closer to the 154 level, it would have lost that reading. I was watching it that closely at the end. It still has a pattern of bullishness, but the upper Bollinger Band is acting as a barrier. But remember, and this is so important, you came out of this base. You've accomplished an awful lot already. You've moved up rather dramatically from in here, 23,500 to 24,536. So if you get a little bit of a break, I don't know that it's the end of the world. In the Russell, the market's been peaking out at the upper Bollinger Band. Here, too, it pushed out on it. This was the more difficult one. It tried to break out to the downside and couldn't do it. And then it reversed right away through here, which was strange and probably caught a lot of the bears at that time. I still don't think it's trending. There's no question you got upside bias in these markets. But you've also had a pattern of a higher high and a lower low. And even when this happened, you had at this point a lower low and a higher high. A very difficult market. In the VIX, each time recently we've gotten over the upper Bollinger Band. What has happened is that the market's fallen back towards this 18-day average of closes. You can go over and over as it's done it. So it's just an observation. Doesn't mean it always has to happen. But what I am noticing is you're not adding much to the VIX. So if we're getting a stock market break and you're not adding to the VIX, I think it's more corrective in nature than a trend change. TLT, I was able to get these ETFs working again. Actually, not me, our vendor did. And we're back to the point of higher lows, higher highs, and uptrend. The market is getting slightly into overbought territory. Doesn't have to get much beyond this. And I don't know how much to look for this in terms of a gain when you've got coming on board the FOMC meeting in a short period of time. And this Friday, you have the employment data. We get ADP data in the morning. They're looking, by the way, for about 200,000 job gain at this point for the Friday number. T-bonds in its uptrend, higher lows, higher highs. Today's action actually confirmed that uptrend. So until you take out 152.12, the bulls grabbed control of the market, but in doing so, they put the market as to what I call overbought. Any reading in the slow stochastic, the SSTO, over 70 via how I teach in my charting course is an overbought number. In the March notes, you're still very much in the bear trend. You've got lower highs, lower lows, so that's not bullish. Resistance 124.17. This market, it's curve yield. The bond market, as the futures go up, your yields are dropping. As these futures contracts went down, they were rising. So it's the flattening of the yield curve that's been going on. In the dollar index, we rallied right on up today. Didn't quite make it to the 18-day average at 93.50. I'd be surprised if we don't try that with this momentum that's turned in it. Battleground, the 100-day average, and now resistance, the 18-day. Because the market is still closed underneath that 18-day, I call the bias still down. But as you can see, momentum's up. You got a lot of divergence on this chart. In the euro, you now turn the swing line down. You got lower highs, lower lows. Notice where the market stopped today. Yesterday it stopped at the 100-day average. The past week it has, in fact, as it's broken. This is the first move back down to the 18-day average, the support. Now, if that gives ground because of momentum turning here, you could get more of a run. In the Aussie dollar, the Royal Bank of Australia came out and they said they're going to keep their monetary policy just as it is. They're not raising interest rates. Now, the key for this market, if it's going to hold this uptrend, is not to get under 75, 79. If it rallies from here, maybe you get up to the upper Bollinger Band again. Battleground, 18-day average of closes. Japanese yen, again, this market's in a corrective mode. You had higher highs, lower lows. The question that people are asking themselves, and you have to, is this is a safe haven currency typically, and an easy money policy currency. In this environment, why were they buying it as much as they were? Once the tax bills got passed, this market has sank back down. We'll see what it does. To me, it's just a market that's walking in this big, broad range, not doing an awful lot. I had the wrong months up yesterday for the crude oil. So what can I tell you? The January Brent is gone. So now I've got February Brent versus February WTI. You've gone from that premium of about 6.25 back down to $5. So simply put, as energy prices went up and you built a big premium into the to the Brent over to WTI, the shipping costs allowed for what? They allowed for a narrowing back of that spread, about $1.50. As we take a look at the February Brent crude, battleground, 18-day average of closes, just seems to be walking back and forth here. It lost its punch when OPEC said they're going to do the production cuts. That was the lead up to all this, and it hasn't gone anywhere since then. I think the market's worried about what the U.S. producers are going to do, but here too, you're very much in sideways action, bordered, and it's been staying this way by the 18-day average supporting the market. Should you get under 66.82, it could open the door for further downside in these markets, maybe even back to the lower Bollinger Band of $55. It's only $2.50 away. So it's not that big of a move. Gasoline market in a downtrend, lower highs, lower lows. Yesterday and today, the Bollinger Band trying to bounce away, but I think the bears have control, and they'll probably watch this 18-day average to protect it. The problem is you are oversold, and that sometimes that leads to bounces. Then we get to the natural gas market, which is still falling apart, even with this super cold weather. Today, what weighed on the market is some of the weather services are changing their opinion as to how cold it's going to stay in the upper parts of the U.S. I don't know that. I looked at the 10-day forecast before I did the show. It still looks to me pretty cold. Yet this market came down again to the Bollinger Band. Last time it hit it, rallied back to the 18-day average. So I'll go on record. I think this is where the bears are covering their short positions one more time. Not that it's a buy down there because the trend is down, but wouldn't surprise me if Bollinger Band offers that support. Let's talk about Modern Trader because their January issue finally came out. And when I say finally, first day of it today. And today is December 5th. So that's what the magazine looks like. Here's the articles that are on it. China's Twitter is ready, 4 times upside for Adamas Pharma. But you go in, you got cattle and corn divergence. You've got the yen at bearish extremes. There's plenty of commodity information, options information, ETF information. They cover everything in this magazine. So it's really something you want to take a look at if you're an investor. And it doesn't get you all lost with, like some of these magazines, algorithms that you're going to use. It's not meant to do that. It's about fundamentals and chart analysis, putting it together in all types of spectrums in the market. Gives you an idea. The tech stocks and energy appear volatile. Why is that taking place? Then you get to the fan tags. You've heard of the FANGs. Well, they've added 2 more to that is all that they've done. Amazon is one of those. Tesla is another one, I believe, to it. So you've got them all in there now, and that's why they coined a new word, fan tag. So you put it together, you play with it, there's chart patterns, gives you an idea of how to learn from all this, where you go with it. Then daily, they put out this publication called Market Focus. It all comes by email. So if you have an email account, fine. If you don't, no problem in trying to get this. It's a $79 a year value if you get it from them. If you get it through us, we go right to them, no charge at all. How do you do this? Well, you're going to give us a call at 866-973-2077. You can go to our website if you haven't signed up for it, a great publication. You'll see all our free offers on the homepage of our website. Click up here. If you're watching me on YouTube or underneath us on many websites, it says click here for Ira's free info. I'm Ira Epstein. You have a great day. I'll see you tomorrow.